This is an audio-visual recording for high school tutoring college. It is meant for educational purposes, highlighting some of the topics that are covered by our staff. Let's start with how a business will create and add value. Through the process of value adding, a business will take resources and combine them into a product that is of more importance to the consumer than the individual resource. Each item becomes a source of value contributing to the final product. For example, when making a hamburger, the main ingredients become inputs. Each input adds value to the hamburger as a finished product. The raw materials are combined with machinery to be cooked, and then human skill is used to make the hamburger. Businesses play a major role in society. Their role is divided by social and economic responsibilities. The economic role of business is concerned with the financial impact that activities will have on the business environment, whereas the social roles are focused on the business impact on the community. Essentially, the main roles of a business are to create wealth, encourage employment, innovate, improve quality of life, promote entrepreneurship, and create choice. However, each role involves social and economic responsibilities of which must be accounted for within every business decision. Wealth creation involves using the allowable funds of a business to create the value or wealth of the business through the purchase of long-term assets. Employment allows for a business to use people to perform tasks relevant to the business's needs. In return for their services, a business will pay a form of income to their workforce, which becomes consumer income to satisfy individual needs and wants. Innovation involves the use of creativity to improve the features of a product. Innovation is vital for a business as consumers' needs and wants are constantly changing, and a business must keep competitive edge over its competition. Innovative products can improve the quality of life in an individual as the goods provide greater convenience and the individual now has a higher level of satisfaction and therefore improving their quality of life. An entrepreneur is an individual who has developed certain ideas and is willing to take a risk to implement these ideas through a business. Through a business, entrepreneurs are provided with an avenue to transform their ideas into actual goods and services. Choice encourages a business to be innovative and to be different from their competitors, leading to consumers paying the lowest possible price for the highest quality good. Moving on to the identification of relevant stakeholders. A stakeholder is anyone who is affected by the decisions of a business. For example, when a business decides to expand into areas such as forests and reserves, areas of environmental importance will be destroyed, becoming a negative effect of business activity for relevant stakeholders. Financial goals are those that relate to the financial performance of the business. They include profitability and long-term growth, which will be discussed further in class. Social goals relate to how the operations and activities of the business can have a positive influence on the community. For example, a business often assists in the support of local charities, which have a positive impact on the community. Personal goals relate to the personal expectations that the owner intends to gain from operating the business. This can be measured by the financial performance of the business or the level of satisfaction employees have while working at the business. Small business is vital to any economy, as many are employed within the small business sector. Defined by the ABS as a business that is primarily involved in the manufacturing of goods that has a workforce of fewer than 100 employees, small business can encourage choice. Within the service sector, a small business is classified as one whose employees are 20 or fewer. A value chain analysis is vital to ensuring the success of the business. By analyzing how much extra value each stage adds, a certain level of efficiency can be reached, maximizing output for every unit of input. If a certain activity lacks efficiency, it can be outsourced. Outsourcing involves hiring an external company to perform a task that your business does not want to complete using its own resources. Moving on to the business cycle. The business cycle shows which stage a business is in while it is developing its product. The establishment phase, in orange, is when the business first enters the market. There are high costs associated with establishing a business, and hence all businesses must go through the establishment phase. Usually, it's characterized by slow growth in sales, and a business may not earn sufficient revenue to cover all its costs. The growth stage, in blue, is when the business first experiences increased sales. More customers are aware of the product, and as a result, the company is expanding. It is usually characterized by increased revenue and market share, and the liquidity or the ability of a business to fund its short-term expenditure become very vital. The maturity stage in green is when the business's growth and market share begin to slow. Usually faced with increased competition within the market, some challenges faced by a business during these maturity stages include the need to develop strategies to maintain customer loyalty and interest in its products. The post-maturity stage in purple is the final stage of the business life cycle. There are 3 stages that a business can go into: steady state, decline, and renewal. In the steady state stage, a business maintains its current financial position. In the decline stage, a business has not been able to successfully address the various challenges that it might have to foreclose. Lastly, in the renewal stage, a business will provide management with an alternative path of which can increase the sales of a business, thus eliminating any thoughts of closure or liquidation. For legal reasons, a business must be classified into a type of business. A sole trader is an unincorporated business with one owner. Liability is an important issue for sole traders. Businesses that are sole traders are unincorporated businesses with unlimited liability. This means that the owner of the business is personally liable for all debts incurred by the business. A partnership is also an unincorporated business that has more than one owner. Businesses that are partnerships are also unincorporated businesses with unlimited liability. A private company is a business that has between 1 and 50 owners. Private companies have a limited liability, meaning that the owners are not personally liable for any debts incurred by the business. A private company has propriety limited after its name. Pty Ltd means that the company is private. Ltd means the company has limited liability, and thus is not personally liable for any debts incurred. A public company is a business that is listed on the Australian Stock Exchange, or ASX. This means that it is owned by shares offered to the public. A public company has limited liability, and no individual owner is liable for the debts incurred by the business. A cooperative is a set-up company where the main owners are the owners of either the supplier side or customer side of the business. Cooperatives have limited liability and can be set up under a financial cooperative, consumer cooperative, or a producer cooperative, all of which perform different functions. Companies limited by guarantee are non-governmental organizations, or NGOs, or non-profit organizations, similar to charities. As their main purpose is not profit, many are subsidized and therefore have limited liability. Lastly, a trust is an organization entrusted to manage the assets of a business. A business operates within an economy, a system where the 5-sector model, businesses, households, consumers, government, and overseas markets interact to satisfy the needs and wants of society. A key factor affecting the business activity is the economic cycle, or variations in consumer and business spending over time. To control this, the government implements fiscal, monetary, and microeconomic reform. Fiscal policy is any change made to the level of taxation affecting both consumer and business spending. Monetary policy refers to actions taken by the Reserve Bank to influence the level of interest rates in order to dampen or lift consumer spending. Microeconomic reform describes policies developed by the government to promote fairer and greater competition within markets. For businesses, microeconomic reform can either be beneficial or have negative effects. As all businesses operate in a market regulated by government bodies, obeying the rules is vital to ensuring business success. Trade unions are one such organization of which protects employees' interests and working conditions. They make a workplace fair and ensure businesses are not taking advantage of their employees. Employer associations are organizations that aim to promote the interests of employers. Again, they make a workplace fair and ensure businesses are not taking advantage of their employees. The Australian Stock Exchange is responsible for monitoring a market where investors can buy and sell shares in public companies. Consumer associations are organizations that provide information to consumers about ranges of products to ensure that they are buying the best product possible. In a modern world, a business must not only meet the needs of its shareholders, but must also operate in a fair and ethical way. This means that the business has a responsibility to shareholders, managers, employees, consumers, and society, and therefore needs to balance between profit motives and ethical practice.